Hello, friends. Today I am giving you an update on the Hershey Company, ticker symbol HSY. We'll be looking at the last performance in the last couple of years and months. We'll look at the latest earnings report, a couple of news and full guidance that they share with their shareholders not too long ago. We'll look at the fundamentals and how things have been growing, and we will also be updating fair value. We'll be calculating that with the new sheet that I showed you a couple of weeks ago. Welcome to Money Talks with Martin Reyes, where we learn to care about our money and find great companies at great prices. Hershey's has been having a little bit of a roller coaster in the last 5 days. It's been up. This week it was up 1.35%. In the last month is 1.2%. In the last year is down 19%, coming up. It actually has dropped more since May, and in the last 5 years is up 77%. The price target of the analyst is $225, which will make it a 16% upside, not including dividends. They do pay a dividend of $5.48, which will make it at this price at 2.8% dividend. Like I mentioned before, they reported earnings on February 8th, and the ex-dividend already passed on February 16th. They are trading right now at 21 times earnings with a forward of 20 times. So we'll be looking at see if this is something that maybe we can jump in. Now, whenever we are looking at the latest earnings, they beat on normalized EPS by 6 cents. But they miss on GAAP EPS by almost 19 cents, which is quite significant. I believe it's like a 10% miss right there. Revenue came at $2.6 billion, which was a miss of $66 million in revenue. They're estimated to report again on April 26th of this year, hoping to report EPS close to the $2.78 mark, which will be higher than the last one that they report. But also remember that this also includes, this will be including Valentine's Day, and also will be including Easter and all those chocolate goodies. Revenue is we're hoping, analysts are hoping that is $3.1 billion. And the last 90 days, they have had 21 revisions, and all of them are down. Part of the revisions down is because of the report that whenever they came up, they gave full guidance. They not only missed almost 11% in income, but they reported that for the 2024 year, net sales growth was going to be somewhere between 2 to 3%, which is very low. And you'll see whenever we compare it with the historical way that they have been growing their sales. And they are giving an outlook of zero growth for earnings, which is something that is creating a lot of people to maybe not have too much confidence. Remember that a lot of the big investors, they're looking for what's going to happen in the next quarter or what's going to happen in the next year. They're not a long-term kind of investors. Maybe if you are, this would be something to take a look at. A couple of other things that we are having with Hershey's is they're cutting jobs because they are really struggling with the cocoa cost. The prices have grown a lot. We talked about this in the last video. I don't want to make this video too long, so if you want to learn more about that, I will encourage you to go back and look at the video. I'll put a link in the description, the last update that I have, and that will give you a little bit of a more conversation about the higher cost on cocoa and sugar, which I mentioned in that video. If you're liking what I am sharing, if you like my channel and everything that I'm doing right now, I will encourage you to subscribe. I think it's only 20% of you guys subscribe, which is thank you for that, but I need more subscribers. I would love to get to 500 subscribers, which is the minimum that I need to start looking at some of the goals that YouTube want us to achieve. And also, I would like you to let me know if you like this by pressing a like or a dislike. Make a comment. Let me know your comments if you own Hershey's, if that's something that you're looking to buy. What is your bull case? What is your bear case? What am I missing? So when it comes to revenue, revenue per share has been growing in the last 10 years about 5%. So if their outlook is of 2 to 3%, that is almost half of what their last 10 years has been growing. And actually, most of the growth, as you can see here, happened since after COVID. There was quite a jump. Before that, it was pretty flat and consistent. With the gross margins of 45%, that is normal. That is average for a lot of these companies. So nothing big there. What also means with the gross margins is that they're going to be pushed a little bit more whenever they're going to hurt more whenever cocoa or sugar or all of these costs start to go up. When it comes to earnings, in the last 5 years, they have been growing at 10%, a little bit above 10%. In the last 9 years, they have been growing at 9%. Profit margins are close to 16% in the last 5 years average, which is really low for me. I like the profit margins to be closer to 25. So when it comes to free cash flow, the last 5 years they're kind of flat. They have grown at 1.8%. In the last 10 years, they have had quite a nice growth of 13.4%. So it's a little bit all over. As you can see here, the growth hasn't been really big. It has been a little bit up and down since 2018. The free cash flow margins are at 17%, a little better than the earnings. So that's good. And they at this the 5-year average of the free cash flow yield is close to 4%, which is pretty nice. Book value, it stands at $20 per share, has been growing in the last 5 years at 19%, and in the last 10 years at 11.7%, which is pretty good. Pretty good. 5-year return on equity average is 60%, which is huge. It's high. This is really good. Return of asset is at 15%, which is really good too. And return on invested capital is at 22, which is it's pretty good. So those are great numbers. The other numbers are a little concerning to me. When it comes to dividend has been growing at 8%. Whether you look at it at 10 years or 5 years, are pretty consistently growing it at 8%. Payout ratio is at 60%, which is not great, but it's not something very, very concerning. Most people like to have it under 50% and above 35%. So when it comes to debt has been growing, but also they are able to pay all of their long-term debt with with their free cash flow average in about 2.5 years, which is pretty good. I like to have it under 5 years. Shares, they have been buying shares, but not really Not really as aggressive as other companies. So in the last 5 years, a little less than 0.5%, and in the last 10 years at 0.7%. Not really great. Whenever we look at all the numbers put together, um, you can see here um, what is all the numbers that we kind of talked about. Great things are in this gold kind of color, and as you can see, the return on equity, assets, and invested capital are great. Same thing, the book value, everything else seems to be a little okay. Blue is normally it's average. Green is a little bit above average. So free cash flow yield is I calculated it at the price that we have right now. That will be at $3, 3.9%, which is pretty high. So yeah, and before we jump into pricing, I will just want to give you a little bit of a disclaimer. Remember that I'm just a YouTuber. I am not a financial advisor. I am not licensed professional. This is just for um, entertainment purposes, for discussion purposes, for educational purposes. So I hope to hear your opinions. This is just my opinions. Do not invest based on my opinions. And yeah, make your own research. When we look at the historical multiple valuation, we take all the per share numbers multiplied by the different multiples of the company. It tells us that the average the market has been valuing Hershey's uh, averagely through between $193 and $231. Which, by the way, I think I just made a new word, averagely. So, uh, whenever we use a revenue-based valuation, in which we grow um, the expected revenue. Now, I am using a 7%, which is the average of the last 5 years. And even with those numbers, just using historical numbers, it gives us a fair value of $182. If we were to assume that that they're going to grow at 3%, just like they're predicting, and then here they go back to the 7%, we're looking at a fair value of $176. So just to give you a little bit of an idea of how these numbers change. Whenever we look at the discounted earning valuation, that's whenever we grow the EPS by 9%. Then after 5 years, we assume we sell it by our average of 26 PE, and then discounted back, it gives us a price, a fair price, somewhere between 155 and 188. Then payback time, we just collect. We assume if we just hold it for 8 years and collect all the free cash flow, it gives us a fair value of somewhere between 164 to 167 dollars. We've used the discounted free cash flow model valuation, growing free cash flow at 5%, same thing that we did with the other one, but using a free cash flow multiple, it gives us a fair value of 153 to 157. Remember, all my valuations assume a 15% minimal require return. And when we look at owner's earnings valuation, we're looking at somewhere between 161 to 172. So whenever we put everything together, it gives us a average fair value of 175, which will be way less than the last average that I gave you in the other video, which was of $190. So this is with no margin of safety. If we look at the history, the last time that they were close to 170, that was on September 2021. This year, this past year they got close. They got all the way to $178. I personally am not gonna invest on this company, especially with all the issues that they are having right now. Um, I know that some of you guys, last video, I had great comments. I will encourage you to watch the other video too and read the comments. I would love for you to put some comments down below, and I hope to see you in the next video. But before that, I forgot to let you know that if you want a copy of this valuation sheet, you can find it at Buy Me a Coffee. The link is down in the description. Have a nice one, and I'll see you in the next video.